Good morning, everyone. My name is Michael Naidrich, and I am the Co-CEO of Amerivet Securities, and I am super pumped today. I have my usual partner in crime, Greg Faranello, CFA, all things rates, Fed, liquidity, and we have a special guest today from Morgan Stanley Investment Management, Senior Portfolio Manager and Chief Strategist, Jim Caron. Jim, thank you so much for joining us.
Thank you for having me.
And Greg, as always, pal, great to see you again. Hope everyone had a good weekend. I'm going to get started with a couple of thoughts here, and then I'll let the two experts take it away. Greg, Jim, give me some thoughts on inflation, wages, and the jolts that are out there.
Jim, it's great to have you. I really appreciate you joining our family today. And let's dive into it, right? I mean, what are your views and thoughts on inflation here?
Well, I know what the consensus is. The consensus is that inflation is transitory, and I'm not going to bore anybody by saying I think it's transitory. What I'd really like to do is explore some of the risks. Now, look, we all get the fact that there are year-over-year base effects. But what we also have to recognize is that some of these numbers have been doozies, right? We had a 5% year-over-year CPI. It's the highest month-over-month rate in the past 30 years. Headline is up as high as it's ever been in 13 years and core in 30 years. So it's hard for me just to say, well, don't worry, inflation remains anchored, it's transitory, let's be patient. So I would say that that probably still is the base case, because we know that a lot of this rise has to do with the pandemic and base effects and things like that. But what we also have to recognize is that this could be causing issues that are restructuring the labor force, wages, wage inflation, the productivity of companies that have now embraced technology and can be more productive with fewer workers, meaning that labor supply, even though there's a lot of labor supply, a lot of it may not come back in all at once, which means that wage pressures may stay higher for longer, and that we may be risking the fact that inflation may not be as transitory as we think, or we should redefine what transitory means. Is transitory over the next 3 or 4 months, or is transitory over the next 3 or 4 years? So I do think that inflation pressures moving higher are something to worry about right now, and that it shouldn't just be dismissed as, oh, don't worry about it, the Fed remains patient.
Yeah, no, I mean, that's great points. I agree completely. It's like, what is the time frame for transitory here? And that leads into, the Fed meeting this week, right? I mean, so we've got the summary of economic projections, right? The SEP, and then we're going to have Powell's presser. What are your thoughts heading into the Fed meeting this week, given what we just discussed?
So I think that's a great question, because it really matters what the Fed thinks. It really doesn't matter what the rest of us think. What are they going to actually do? How do they actually see this? If the Fed comes out and has the boilerplate, we remain patient and we're not worried about inflation, remains anchored, and doesn't really start to change the scales of risk in saying that, maybe potentially rates may have to move higher sooner, then I think what the market is at risk of doing is overheating to some degree. So how does the Fed communicate this? Well, right now, if we look at the dot plot, I know that's not the best measure of things, but it's a measure of looking at sentiment on the Fed. Right now, it would take about 2 people to raise their votes for a rate hike in 2023 to move that long-term dot, like the first full rate hike coming into 2023. Right now, what the summary of economic projections are telling us is that the first rate hike will not be until 2024. The market has it priced at early 2023. We need at least 2 people to start to say, well, we think that it may be, it may happen sooner on the Fed to give us that signal. So now that would make it 9 versus 9 at that point. You need 3 people to actually push that dot into 2023. I think it's going to be hard for the Fed. It could be hard for the Fed to get 3 voting members to raise their forecast for the first rate hike to be in 2023. Now, if that happens, that's going to signal that the Fed will now start to move, not in 2024, but sometime in 2023. It will confirm what the market is already pricing, But we have to recognize that the signaling mechanism is important. The second thing is in terms of tapering. So as we know, the Fed is buying 120 billion securities per month, 80 in US Treasuries, 40 in mortgages. The Fed can't tighten rates until they're done tapering. So what that also does is it moves up the time frame and maybe the speed at which the Fed may actually start to taper. So that's signaling that the Fed may start to hike in 2023. If it happens, actually has knock-on effects to tapering and to everything else, and really starts to signal to the market that there could be a tightening of policy sooner than what many have been thinking.
Yeah, no, I completely agree. It's a great summary, Jim. I look at the market now. I think most participants are looking at the market right here. You and I have talked a little bit about the transmission of all of what you're talking about into interest rates, right? We have a 10-year now that's at 150. There were so many people that were saying, 10 years going to 2.25, 250, maybe 3 or 4%. What's your view on rates right here, given everything that we're talking about heading into the Fed meeting with a 10-year close to 150?
So I think the broader trend for interest rates is higher. And right now we're seeing a correction. So we saw a rapid move in 10-year yields from the beginning of the year to the end of the first quarter until the last several weeks, where yields moved up very, very quickly over a very, very short period of time. And I think that without yields continuing to move higher, that some of the bears in the market got disappointed, and there was some short covering. And the Fed has been talking the patient talk, so people have been more than willing to cover some of their shorts. The market seemed to me somewhat thin in this respect. So it doesn't take a whole lot to start to move these yields a little bit lower. I think it's going to take a lot of energy to get 10-year Treasury yields to go materially below 1.35% or 1.3%. So right now, at about 1.45%, I think this is in correction territory. But I also will say, though, that it's also going to be difficult for 10-year yields to really rise materially beyond 1.75% this year, unless there's a change in a catalyst where the Fed may start to signal a sooner tightening or more aggressive tapering than what the markets previously thought, or we start to realize that inflation pressures aren't actually transitory. So essentially, this is going to take some time to play out. But for right now, I think the number one thing is volatility, right? So volatility, look at the VIX index, that's been coming down. What happens is that when people believe the Fed is patient and we're going to stay in a range, well, people start to reach for yield. Foreigners start to reach for yield. The U.S. yields are still higher than many other parts of the world. So there becomes more demand that starts to come in for U.S. bonds, and this is collectively going to push yields a little bit lower in the absence of a catalyst that makes people want to aggressively start to move short the market or put on bearish positions. Because remember, for a fixed income investor, we all like carry. When you're short the market, you're giving away carry. You're giving away that part of your return. So we'd all prefer to be long. So in periods when rates aren't rising, we'd rather own the market to capture that carry and to capture that return. But again, we're looking for the catalyst. And right now, the catalyst isn't obvious. Maybe on Wednesday, we'll get one.
Now that's great. It's interesting, Jim. In our notes to clients over the last week, we talked about carry, right? It's expensive to be short in the end. You see the Fed's programs, you see the reverse repo program, cash coming back into the marketplace. It's very expensive to be short the market in the end. And I do think positions have come into play here for sure. So thank you so much. Mike, I'm sending it back to you, my friend.
Looks like we might be up for a summer melt-up in equities. We'll find out. Hey, Jim, absolutely just grateful as a firm for having you today. Thank you for your incredible insight and kindness for joining us today. And Greg, as always, thank you for being as prepared as you are. And we'll look for you to, really investigate the presser and everything else after this week's Fed meeting. If any of our clients would like to speak to Greg, please talk to your representative, and we're happy to get him on the phone. As always, we wish everyone continued safety and a great week ahead. Thank you, everyone.